All right, let's get right into it. Today, we're going to build a professional-grade trading plan from the ground up. And to make it real, we're going to use one of the hottest, most talked-about stocks on the planet, NVIDIA, as our live case study. This isn't about guesswork or hot tips. It's about building a solid, repeatable process that you can use on any trade. You know this feeling, right? A stock like NVIDIA is just screaming higher. It's all over the news, and that fear of missing out, that FOMO, is kicking in hard. You're asking yourself, do I chase it? Did I already miss the big move? This is the exact moment where emotion takes over and wrecks portfolios. But for a professional, this isn't a moment of panic. It's a trigger. It's time to pull out the plan. So here's our game plan. First, we'll tackle that core dilemma every investor faces. Then we'll build our strategy, piece by piece, a smart entry, rock-solid risk management, and a clear plan for taking profits. By the time we're done, you'll have the complete playbook. Let's kick it off with the biggest challenge of all. And this really gets to the heart of what separates amateurs from the pros. See, amateurs are basically betting on being right. They're trying to predict the future. Professionals, they plan for both outcomes. They have a plan for when they're right, and just as important, they have a plan for when they're wrong. It's not about having a crystal ball. It's about having a playbook for every possibility. This is the big mindset shift right here. We have to stop trying to guess exactly what NVIDIA is going to do next. It's impossible. Instead, we're going to focus on identifying zones where the probability is in our favor, defining exactly how much we're willing to risk before we even get in, and setting logical targets to take our profits. We're not fortune tellers. We're risk managers. Okay, this brings us to the first pillar of our plan, the entry. Let me be clear. Where you buy a stock is one of the most critical decisions you will make. A great entry amplifies your gains and gives you a cushion against being wrong. A bad entry, well, it puts you behind from the very start. And this right here shows you the incredible power of just being patient. Let's say you buy right away at $190. Your risk to reward is about 2.8 to 1. It's okay. But look what happens if you just wait for a pullback to a key support level around 75. That same ratio explodes to 5.5 to 1. Think about that. It's the same stock, same company, but a vastly superior trade structure, all because you had a plan and waited for your price. Remember this number, 5.5 to 1. That means for every single dollar you put at risk, you have the potential to make $5.50. This is the kind of lopsided, asymmetric bet that professionals live for, and you create it entirely with a disciplined entry. So you ask, how do we get that better entry without risking the stock running away from us? Well, for most people, the best tool is dollar cost averaging. Instead of throwing all your money in at once, you break it up into smaller pieces or tranches. Maybe you buy a quarter of your position now, and then you have orders waiting to buy more if the stock dips to those key levels we identified. This takes away all the stress of trying to nail the exact bottom and gets you a much better average price over time. Okay, let's move on to what is, without a doubt, the most important rule in trading, period. Before you even dream about profits, you have to define your risk. This is not a suggestion. It's not a guideline. It is the absolute law of protecting your capital. You have to know your exit for a losing trade before you ever hit that buy button. Now, a pro's stop loss isn't just some random number. It's based on their time horizon. A short-term trader, for example, might have a really tight stop, maybe just 4% down from here. But a long-term investor, they can give the stock much more room to wiggle, maybe setting their stop 18% lower, below a major long-term support level. Your strategy dictates your risk. For the tactical plan we're building, that key stop-loss level is around $175. From our entry zone, that's about an 8% maximum loss. That's it. It's manageable. It's defined. A small controlled loss is simply the cost of doing business. An uncontrolled, catastrophic loss is what takes you out of the game for good. These are the rules to live by. First, never, and I mean never, enter a trade without knowing where your exit is. For NVIDIA, a solid break below 175 isn't just a dip anymore. It's a warning sign the whole trend might be changing. Now, once you're up, say 15%, you start moving your stop up to protect those profits. And if you do get stopped out, don't panic and jump right back in. Let the dust settle. Wait for a new setup. All right, we've protected our downside. Now for the fun part, taking profits. You'd be amazed how many people let a huge winning trade turn into a loser because they just don't have a plan to sell. A professional knows exactly where they're going to start taking money off the table. This is how the pros do it. You almost never sell your entire position at one single price. You scale out. When the stock hits your first price target, let's say $210, you sell a piece, maybe a third of your position. That locks in a gain, it pays for the trade, it takes risk off the table. Then you sell a little more at the next target, and so on. This makes sure you actually get paid for being right. There's a great name for this technique, regret minimization, and just think about why. If you sell everything and the stock doubles from there, you feel regret. If you sell nothing and the stock comes all the way back down, you feel regret. By selling in pieces, you bank profits while still keeping a piece in the game for more upside. It's the best of both worlds, financially and psychologically. Okay, let's bring it all home. We've defined our entry strategy, our risk management, and our profit-taking plan. Now let's combine all of those elements into one single, simple, actionable playbook for NVIDIA. Here it is. This is your cheat sheet, the whole trade on one slide. The best place to buy is between 175 and 185. Your non-negotiable stop loss is just below that level. Your first profit target is around 205, and your main target is 220. These are the numbers that matter. So, what's the final verdict? What should you do right now? It's simple. Do not chase the stock up here with your full position. The professional move is to either wait patiently for the price to come to you back into that primary entry zone, or to start scaling in with that disciplined dollar-cost averaging approach we talked about. And here's exactly how you put this plan into action step by step. First, set price alerts at those key levels so you don't have to watch the screen all day. Second, decide on your total position size. Third, go ahead and place your first buy orders down in that 175 to 185 zone. Fourth, and this is crucial, as soon as you get filled, you immediately set your stop-loss order at 175. Fifth, know your profit targets ahead of time. And finally, remember, this plan isn't set in stone. You monitor and adjust as new information, like an earnings report, comes out. At the end of the day, any stock's potential is only half the story. The other half, the part that really separates the consistent winners from the gamblers, is having a disciplined process. That's how you stop speculating and start trading like a professional.